welcome everybody. Welcome everybody. There we go. Just turned my phone off, got everything ready to go. This is my first conference in about 3 years. I'm like Jay Martin, I don't speak at my own conferences, so I actually haven't had a lot of experience keeping up with everybody, but what I thought I'd do here, because I haven't been out for quite a while, is just kind of give you a bit of an update on where we're at with oil and gas and what I've been doing for the last 3 years, which has been pretty dark times in the energy patch. Up until about 6 months ago, oil and gas prices were really low and there wasn't a lot going on. So we had to kind of get creative in how we make money. So I'll go through a few of those ideas with you as well, and then kind of bring you right up to the present here and give you a rough idea what I'm doing now, why I'm doing it, and the areas that I'm investing in and the areas that I'm avoiding. And I'm hoping, because I've only got about 10 slides here, that we'll be able to run through these fairly quickly. And then if you guys have any questions, we got 20 minutes. If I can run through this in about probably 10 at the most, then lots of time for questions, or I get to go early for a beer. Okay, so one of the things we're going to talk about here is oil, where things I think are a lot better than you might think. Even though we've already had a great run, I think there's quite a strong argument for near to medium term that things are going to be even better, particularly for the equities as much as the oil price. And gas is still a big place to avoid. And I'm going to go through some of the very simple numbers there that really, you can make this as complicated as you want, but the reality is that there's a few very basic numbers here, particularly on the supply side, that are so huge you just don't need to worry about gas prices right now. And as I said, what did I do during the downturn, and what am I doing now? So I think there's a huge difference this cycle in the oil stocks compared to all the previous oil stocks that we're used to. If you think back of the big run that we had from 04 to 08, and then 9 to 12, 09 to 2012, and then again from the cycle that we're in now, which let's say started around early 2015, one of the big differences here is these companies are in much better financial position. Their debt is about the same, but their free cash flow generation and their cash flow is much, much greater. And there's a couple reasons for that. One is that the technology has really improved a lot. Every year we keep thinking, oh, well, we did 20% better this year and 20% better the year before that, but now it's just going to be small. It's going to be incremental. It's going to be like inches, not feet. But that hasn't been the case. We are now drilling wells so much faster, drilling wells so much longer, fracking so much more intensely that we are getting so much more oil per linear foot than we ever have in the past. And that's just driving cash flow through the roof on really across the entire industry. So what that means is that if you look at back in 2014, we did a survey of about 40 U.S. companies. None of them are in Canada because we don't really care about Canada too much up until recently. But it costs $31 a barrel to keep your production flat. So what that means is if you were producing 10,000 barrels a day in 2014, your production declines every year, usually 3 to 5% if it's a mature field, and a lot more. Most of these junior oil stocks will decline anywhere from 28 to 42% per year. So they've got to spend a certain amount of money just to keep that production flat at 10,000 barrels a day. We'll use that as an example. So in 2014, that was $31.61 a barrel. But then after the crash, the service sector really bore the brunt of most of the downturn in costs. So while economics actually improved in terms of technology and costs dropped, the maintenance capex for these companies dropped to $18 in just 2 years. Now that's a huge drop, and it's still dropping. I say 2018 because we just put this study out a couple of months ago to subscribers, but the reality was we were looking at Q3 2017 data when we did that. And so right now, we're producing oil and gas so much better than we ever have in the past that we're now able to keep our production flat for just $14.85 a barrel. So what does that really mean? That means a lot more cash flow to either grow production or do other things like share buybacks, dividends. So the point here is that there is a lot more money in the oil patch now than there has been in any cycle we've gone through before. So, and it's interesting that that's happened because really you would think because we are making so much more money that these oil stocks would do a lot better. And really up until a month ago, they weren't. They were doing horrible. Oil stocks lagged the oil price on the way up in this cycle way more than we ever thought. You know, these oil prices gone up from 45 to 70 bucks since last July. And really it's only been in the last 6 weeks that oil stocks finally got up off the mat and started acting the way they should, given how much cash flow that they're doing. And really, I think that's just because the market wasn't willing to believe that the Saudis or somebody else wasn't just going to turn on the taps, and they just saw how much U.S. oil production was increasing, but everybody was missing the demand equation. We're adding 1.5 million barrels a day, 1,500,000 barrels a day of new demand every single year for the last 4 or 5 years. So all the U.S. production's doing when it's going up 1 million barrels a day is just filling that new demand. And everybody else's fields are still declining. Everybody else is producing flat out as fast as they can, except for the Saudis. The world's basically at 100% capacity. So all this oil is just getting soaked up. So, but really the industry did get the message, though. The industry got the message through the last cycle that, okay, you guys tried to grow too fast, you put on too much debt, so when things happened, when the normal business cycle happened and things started to roll over, these stocks just got crushed. A lot of them lost, no word of a lie, 90 to 95% of their value. You look at a big company like Baytex in Canada, stock was trading $65 a share. It has one of the most respected management teams in the Western world. That stock bottomed a year and a half later at $1.80 from $65. Like, that's crazy on a well-respected team. So now what they've done is they're growing a lot more slowly. They're using their cash a lot more judiciously. They're paying down their debt. They're doing buybacks. They're increasing their dividends. And so they're really being much more prudent with their cash, which is exactly what you would want to see them do. And, of course, everyone got frustrated because they didn't really get rewarded for that for a while. So, and what we're seeing now is if you did a big deal back in 2013, 2012, and you did a multi-billion-dollar deal, your stock went up, everybody was happy, everybody was growing. But now these big deals get punished, and stocks go down. So you're really seeing M&A values and the number of deals coming way down unless they really, really, really make sense. Before, the stock, everyone was so excited about oil stocks that they did deals just to do deals. Now they don't do that anymore. They've really got to make very clear and obvious sense to shareholders. So like I said, investors, we were frustrated despite the fact that all these companies were doing really well. Nobody believed in the oil price, and even the management teams didn't believe in the oil price. And we saw this in copper in 2004, we saw it in uranium in 2007, and we're seeing it in oil now. As soon as oil got back above 50 bucks for the first time in a year, all these guys, they said, oh, this is a gift from God, and they hedged like crazy, and the oil price just kept going. And that just goes to show that just because you're in the industry, whatever commodity you're in, you don't know anything more than anybody else. So, particularly in the States, and we didn't do quite such a bad job in Canada, but certainly in the States, most of the juniors and the intermediates who really need cash flow certainty, they hedged away a lot of their profits now. Their hedge books are deeply underwater with oil here at 70 bucks now. But like I say, these stocks weren't going up even with a lot of free cash flow being generated. So the management teams were frustrated, investors were frustrated, I was frustrated. But now things have turned. So for the first time in a long time, we're bringing our money back into Canada after being down in the States, particularly in the Permian Basin for the last 3 years. And the reason for that is that U.S. stocks generally are very gassy. They call them oil stocks, but they're not. In Canada, we do have true oil stocks, and there's a couple reasons for that. The big reason is our geology is quite a bit shallower. So when you're looking for hydrocarbons underground, you've got heavy oil really close to surface, then light oil, then liquid-rich gas, and then dry gas. And so obviously you get more heat and pressure that cooks the hydrocarbons the deeper you go, and that's just the natural way that hydrocarbons get cooked. They get cooked down into pure methane after a lot of time and a lot of pressure. So because we have very shallow geology, we have lots of real oil stocks. Like a lot of our companies up here are 90% plus oil. In the States, that never happens. I think there's 2 companies in the entire United States that have more than 90% oil. They're just so gassy, and gas isn't worth anything. So that makes us a lot more value, the stocks up here a lot more valuable. Plus the fact that these stocks had the living daylights kicked out of them. They were trading at 3.5 times cash flow versus like 7 to 8 down in the States. So there was just, and you've seen that chart rebound in a lot of these stocks in the last 6 weeks in Canada, where they have just gone like this. Baytex, Athabasca, all the heavy oil stocks have just done unbelievably well. And deservedly so, because these companies are cash cows right now. They are absolute cash cows. You're looking at a Canadian dollar that's 76, 78 cents. You're looking at WTI that is $70, and given that exchange, it's almost $90 Canadian a barrel right now today for our oil. So these guys are minting money. Now, the idea of coming back to Canada isn't a gimme. It's not a free-for-all. There are 2 big problems buying Canadian energy stocks right now. One is that our multiples continue to be very, very low, and that's for a couple reasons, I think. One is that as the shale revolution really got going in the last cycle, it was a big land grab. Everyone was racing to grab as much raw land as they could. Now everybody has as much land as they want, and they really don't need to buy anybody else to get bigger unless that company and their land is basically right beside yours, and owning them would allow you to drill longer horizontals, because that's where the industry is going. We started off doing half-milers, then milers, then mile-and-a-halfers, 2-milers. We're now regularly seeing 3-mile horizontals down in the States on wells that cost $12, $15 million. So that's really, you want to get a contiguous land package as much as possible. Like Spartan was one of my top picks. It is a great company, great team. They've got fast payback wells, the most free cash flow of any junior I could see. They got taken out for 4.5 times cash flow. They took a deal from Vermilion because they realized Vermilion was the only buyer around. Nobody else was going to buy them. And that management team had some incentive to sell early, so they did. And then you look at Raging River, another Canadian favorite. No one's buying them, and no one wants to buy them. And so here you've got one of the top teams in the history of the Canadian oil patch sitting around twiddling their thumbs wondering, what are we going to do now, because nobody wants us. So the problem here, again, when you're buying these Canadian oils, is that they still have quite low multiples, which means your leverage is a lot lower. So just quickly, I want to skim through a lot of this stuff here. So during the downturn, we couldn't buy oil or gas stocks because they weren't making money. So we went to the power sector, the downstream energy sector, where a lot of innovation is happening. We invested in companies like SolarEdge that has a solar inverter. That stock's gone from $20 to $70 in the last 10 months. I'd love to tell you that I was there for the whole ride. I wasn't. I'm kind of sad. I sold that one a lot too early. But I'm actually a really good stock picker. I'm not such a good trader. And Power Secure had a really neat technology that incorporated many different kinds of power seamlessly with its software, so companies could always pay the least amount, and it got bought out by a big utility. Creus Energy, again, just what I try and do, I go where the money is. If there's no money in upstream oil stocks, well, then go find somewhere else in the energy sector that we can make money. And so that's what we did. And now the 2 things here, and I think this still holds true, small companies that I used to do a lot of work in, I don't do much work in small companies anymore. Oil and gas is a big man's game. Juniors are really tough. Starting from just 1,000 barrels a day or less, it's almost impossible to grow without constantly going back to the market for new equity, and the market just isn't there anymore. The market hates small companies. Natural gas, even big companies in the U.S., I wouldn't go near them. Right now, we're producing about 7 BCF, billion cubic feet a day more than we did this time last year. And the United States is increasing its gas production by about 1 billion cubic feet a day a month right now. So even though we ended March, we came out of the winter with a lot less gas than we have in previous years, we're going to refill that gas at a much quicker pace than we've ever seen before. So nat gas stocks are basically dead in the water, really, I think, right through till we see what next winter holds. So next March, we'll have a better idea on what gas is going to look like in gas stocks. But really, for the next year, you don't need to worry about gas. There's going to be lots of it for everybody, everywhere, all around North America. And service companies, I'm kind of changing my mind here. The service companies are starting to get some pricing power for the first time in 3 or 4 years. So those valuations have been beat up pretty bad. So companies like Calfrac, CFW, Precision Drilling, PD, down in the States, some of the frackers, ProPetro, symbols PUMP, PUMP, they're starting to get pricing power, and their charts are starting to look better. So even though I haven't really bought many service companies, I'm starting to change my mind on that a little bit. So like I said before, there's basically no such thing as oil stocks in the States. They're all 30 to 50% gas. There are literally only 2 stocks with more than 90% oil, and there are none between 80 and 90, and all the rest are between mostly 60 and 70, with a few between 70 and 80. That really impacts your economics because gas is basically worthless. So your realized pricing is much lower than WTI. So if you think of WTI today being about $70 bang on, most U.S. producers, small and mid-cap producers, their end-of-the-day realized pricing, when you factor in the gas, the natural gas liquids like butane, propane, ethane, is about half that. So you can count on basically half to 2/3 of the price of WTI as being the real price that all the Americans get, whereas the Canadians actually do get very, very close to WTI. So, yeah, and that's what I just talked about. So, yeah. In Q3 2017, when we did our last study, WTI averaged $48, but the average realized price was $26. So that's because gas is worthless, and these natural gas liquids are worthless. No, well, not worthless, but a lot less than oil. So, as I talked about earlier here, the numbers are very simple. You know, we're up 7 Bs a day over last year. Domestic demand's pretty flat. LNG exports are up 1 to 2 Bs a day. That's an extra 5 Bs a day supply. So there's just no way there's going to be any pricing power in nat gas or nat gas stocks. So you can just kind of forget about anything, particularly down in the States, but even up here in Canada, these nat gas producers, they're actually getting a lot of love right now because there's all this chatter about Canadian LNG that's about to start, and it will. Shell's going to go ahead this year, but that's just emotional. There's going to be no fundamental improvement in natural gas pricing for Canadian stocks for years. And like I talked about, right now, nat gas in the States used to be all about the Marcellus formation. In Pennsylvania, it's been the monster. It's gone from 3 to almost 30 BCF a day in the last 7 or 8 years. But now, so many other formations are now economic because, like I say, we're doing longer laterals. We're fracking much more intensely now. Not every 500 feet, but every 80 feet. And we're putting more sand down in each of those fracks. So we're getting so much more gas, so much more oil. The break-even cost for nat gas is now like $1, and gas is trading here today around $2.80. So every other formation in the States is economic now, and the production is just coming on like mad. We're able, even though the rig count's not going up, we're able to get so much more out of the ground than before. And of course, the Permian, all that nat gas is basically free. It's all done on oil economics. And so we've gone from basically 0 nat gas out of western Texas 5 years ago to 8 BCF a day now. And the States uses about 80 BCF. So 10% of the U.S. demand has come out of the Permian out of nowhere just as a production of oil. 1 minute to go. So really, if oil is good and prices are high, they'll keep producing, but that brings all this more associated nat gas that they're basically giving away. So what's good for oil is bad for nat gas. So I'll give you a couple stocks to consider here. Down in the States, Ring Energy, it's the oiliest stock. That report can be downloaded from my website for free off the homepage. That's the stock that we've been promoting for quite a while. Great structure, great team, great asset. They've made lots of money for shareholders before. In Canada, Athabasca is one here that as the oil price continues to move up, again, a very strong team, fantastic assets. They bought a big asset off Statoil last year for 15 cents on the dollar. It pays out in 3.5 years. It's a 50-year asset. It's just a fantastically well-run company. And they've got Murphy Oil spending about $200 million on their plays. So those are a couple ideas to consider. We don't have time for questions, but I'll just hang around at the back for a little while. I got to run off to a 3 o'clock meeting, but I'll hang around the back here if there's any questions. Thanks for your time today, guys. God bless.